You believe the money in your bank account is really there, right? Let's be honest for a moment. It isn't. That's not a metaphor. It's not conspiracy talk. If everyone walked into their bank tomorrow and tried to withdraw their money at the same time, the system would collapse within hours. Because the money isn't sitting in a vault. It never was. This isn't a mistake. It's not a bug. It's how the system was designed. It's called fractional reserve banking. And it's the quiet engine behind modern debt, inflation, and the feeling that we're richer than we really are. To understand this, we need to step away from apps and screens for a moment. There was a time when money was real. Gold, silver, something you could hold in your hands. But carrying gold was dangerous. So people began leaving it with goldsmiths, men with strong vaults and armed guards. In return, the goldsmith gave them a simple paper receipt, a promise. Bring this back, and you'll get your gold. Soon, people realized something important. They didn't need the gold itself. They could trade the receipt instead. And that's when the trick was born. The goldsmiths noticed that almost no one came to withdraw their gold at the same time. Out of 100 depositors, maybe one showed up on a given day. The rest of the gold just sat there. So the goldsmiths got clever. They began issuing more receipts than gold. If they held 1,000 coins, they might issue 2,000 claims. The extra receipts were loaned out, with interest. They were earning money from gold that didn't exist. As long as everyone didn't ask for the real thing at once, the illusion held. That small trick changed everything. Paper promises replaced physical reality. Goldsmiths evolved into banks. And eventually, governments embraced the system. In 1694, the Bank of England wasn't created to serve the public. It was created to solve a problem. The Crown was drowning in war debt. The bank loaned money it didn't fully have, and the government paid interest using future taxes. Sound familiar? The United States followed the same path. Banks issued notes backed by gold, then quietly issued more notes than they could redeem. Periodically, people panicked. They demanded their money. Banks collapsed. And each time, instead of ending the system, governments chose to protect it. That's why central banks exist. Now let's bring this into the present. Imagine you deposit $100 into a bank. You think that money is just sitting there, waiting for you. It isn't. The bank lends most of it out. That money gets spent, deposited again, lent again. Your original $100 multiplies across the system. But here's the key detail. Only a small fraction of that money exists as cash. The rest exists as debt. And today, the system has gone even further. In the United States, banks are no longer required to hold any reserves against deposits. Zero. Since 2020, that rule is gone. So what stops banks from lending infinitely? Not reserves, capital rules. Under global regulations written in Basel, Switzerland, banks must hold enough of their own equity to absorb losses. That's the leash now. And here's the most important shift of all. Banks don't lend deposits anymore. They create loans first, and deposits appear afterward. When you take out a mortgage, the bank doesn't hand you someone else's money. It types new money into existence because you agreed to pay it back. That's why over 90% of the money in circulation today isn't central bank money. It's bank-created money, born as debt. This design creates three unavoidable outcomes. First, inflation. As credit expands, each unit of currency loses value. Second, permanent debt. Because money is created as loans, There is always more debt than money. Interest guarantees the system never fully balances. Third, concentrated power. Asset owners benefit. Banks collect interest on money they never truly had. Governments fund wars and bailouts quietly. Workers fall behind. When confidence breaks, the illusion cracks. 1929, 1930, different decades, same mechanism, and every time the response is identical. Create more money. Add more debt. Keep the system alive. Here's the uncomfortable truth. The system cannot survive if everyone is debt-free. If all loans were paid off tomorrow, the money supply would collapse. That's why money isn't wealth. Real wealth is skills, knowledge, productive assets, and independence. Things that exist outside the debt cycle. This isn't paranoia, it's awareness. History doesn't repeat, but it rhymes. The goldsmiths of medieval Europe, the bank panics of the 1800s, the housing bubble of 2008, all echoes of the same story. A system built on promises, and a public that believes until it can't. If this gave you a new way to see the world, subscribe. History doesn't just tell us what happened. It shows us what we can't afford to ignore.